Welcome to Making Money. This is Matt McCall. Thanks for joining me. It's the 27th of July, 2023. It's a Thursday. Yesterday's a big day. The Fed came out and raised interest rates by 25 basis points. That was really already baked in. We all knew that was going to happen. But of course, we didn't know what Fed Chairman Jerome Powell was going to say afterwards. After that closed and the markets shut down, I brought on Paul Schatz, a good friend of mine. He's the president and founder of Heritage Capital. He was on a show back in February. Him and I have been on TV doing shows for over a decade plus. So I wanted to get his insight into what it really meant, and more importantly, what it means for your portfolio, and his view on where the Fed's going to go in the future, how we play that, what sectors are moving, and of course, we get his favorite stock. He actually picks a stock, folks, for the next 10 years. So coming up right now, Paul Schatz. Over 1 million people around the world follow Wall Street veteran Mark Chaikin for his shockingly accurate stock market predictions. He just gave them a dire warning. Mark says we're about to witness an historic stock market shakeup that can soon create devastating losses for investors who don't know what's coming. And as a result, you only have 90 days to move your money. You see, Mark spent 50 years on Wall Street at some of the most prestigious hedge funds in history. And he's been on Fox Business and CNBC countless times. But this is a financial story no one else is telling. And if you let this take you by surprise, you could be in for a world of pain. He explains everything in a brand new free report available at rollingcrash2023.com. He includes a name and ticker of a popular stock that could be directly impacted by what's happening as well. Mark warned of the beloved pet brand Chewy before it fell 45%. Tech company C Limited before it fell 66%. Furniture company Wayfair before it fell 76%. Social media favorite Snap before it fell 36%. And food delivery company DoorDash before it fell 65%. Mark even called the Amazon crash before the FANG stock fell 35%. So you want to avoid the stock in this new report immediately. Again, simply go to rollingcrash2023.com for your free copy of this new report. All right, folks, welcome to the Fed Special. And I got a special guest coming up here in 1 second, but let's give you a quick recap of what happened today. No big surprise. The Federal Reserve raised interest rates by 25 basis points, now in a range between 5.25% and 5.5%. It's the highest level in 22 years if you take that middle of the two numbers right there. It was a pure unanimous decision. Again, not surprised there. This is now the 11th time the FOMC has raised rates since it began this tightening cycle back in March of 2022. And the Fed continues to signal that further rates might be on the horizon. So let's bring in our guest right now. Paul, as I mentioned, we have Paul Schatz coming in today. What's your thoughts on the Fed today? You know, not much happened in my opinion. What was your first initial thoughts, Paul?
Pretty much as expected. I think Powell played it super close to the vest, given how the market did not respond positively last time and how he typically puts his foot in his mouth during the presser, tries to walk it back a little bit at the end. He was about as bland and plain vanilla as you can be. I mean, we were talking earlier. I mean, literally, you could have sat back in your chair, put your feet up on your desk and taken a nap because there was nothing to chew on. If I had a lot of confidence in Jay Powell and the Fed, I'd say this is a guy who's telling us, folks, that we're done. The runway's here. We're laying the groundwork. But look, they were wrong in 2020. The runway opened up and they were talking about still providing more accommodative measures. You know, the horse got out of the barn and they sat there and, did nothing. So could they raise again? Yeah, they could go. They could go another time or two. It's the wrong move. The market has told them that. Jay, it's the wrong move. Stop. But you said it was a unanimous decision. So, and we got Bullard retired. There's a lot going on in the Fed the next couple of months.
You know, you talk about there wasn't much action. You know, before it came out at 2:00, the S&P is around 45.56, give or take a point. And it closed a couple of points above that. I mean, we did have a little bit of a rally in the beginning of the presser. Then towards the end of the presser came down. But really, it's very muted reaction. And as most people know, normally on Fed Day, you're going to have action all over the place. Let me throw some numbers out at you here, Paul. Before the meeting, early this morning, the odds of a rate hike in September So next meeting, we're 19%. Now they're 23. The odds of a rate hike in November were 41%. Now they're 36. So they're basically still saying that most likely going to hold. But what I found interesting, I looked out a little bit further, 25% chance there's a rate cut in January. If I go out to next July, so basically looking at 1 year, Paul, there's a 97% chance of a rate cut and 86% chance of at least 225 basis point rate cuts by then. I mean, I didn't see anything today that he said that there's going to be a rate cut anytime soon. I feel like he qualms that down pretty quickly.
And he even pointed to the folks who are looking for rate cuts. Matt, let's go back 6 and 9 months. Think about how many pundits came into this year with rate cuts the last quarter of 2023. Some people had 3 rate cuts in their forecast. I'm like, what are you looking at? There's nothing that suggested a rate cut in 2023. Now, I don't know who those people are, but I'm guessing the same people have pushed their thoughts into 2024. The Fed, because they were so embarrassingly late in cutting rates, unless we have some kind of exogenous event, that's a big qualifier. If there's no big event, they are going to be really slow to cut rates. They're going to give the market, a runway as long as a 747 to take off to let people know we're cutting rates. It is not imminent. That jobs market remains incredibly almost, it's a head scratcher strong. So, I mean, the rate cut thing. And the other thing I want to say is those odds that you and I both look at, they're pretty good, weeks and maybe a month out. But those odds, too, were calling for rate cuts 7 months ago.
I was going to say, I don't remember the numbers exactly, Paul, but I do, vaguely looking beginning of the year, they definitely were calling for at least 1, if not 2 rate cuts by the end of the year. The same numbers we're looking at here. Somebody did ask him in a presser. They said, are you going to hike until you get inflation down to 2%? And he was quickly to say, no. Once you start seeing it get there, because if you wait till 2%, it's too much. But we already have CPI down to 3%. Granted, it's a headline number, core's higher, the PCE is higher that they look at, but that's down to 3. And obviously we're moving that direction. So at what point do they sit back and say, let all the work that they've done flow through the system?
Matt, there's a lot there. So first, let's remember all the 0.75 point hikes last year. You and I both know it takes 6 to 9 months for hikes to filter into the economy. I feel like some people think, well, they raised rates today, 0.75 point hikes. They raised rates today. Therefore, the economy should feel the effects tomorrow. It takes 6 to 9 months. A lot of that work from last year isn't even in the economy yet. If you run a big company, think about what your cost of capital has gone from to over the last 18 months. That hasn't filtered into the economy yet. We haven't seen a lot of companies have to refi debt, especially high yield debt. So I think people are a little too, what have you done for me lately? Show me what's in front of me right now, rather than how it normally works is we've got a lead lag time.
So, the big term that they've been using for a while now, the Fed that is data dependent. And, listening to the presser today, I must have heard that 15 times, data dependent. And I understand what that means. And, we have 2 jobs numbers and 2 inflation reports before the next meeting. So there's going to be a lot of data that they can analyze. And yeah, I understand you don't want to make that decision based off until before this information comes out. I'm in the same camp with you. I don't think they should have raised today. I think they probably shouldn't have raised the last 2 times. I think they should have pause for a while and let it figure itself out. But, all that being said, data dependent, do you think we could get in a situation where maybe they pause in September and then the next meeting they raise? To me, that's just, if you're going to do it, Paul, get it done, right? I don't understand what the pause and start is helping anything.
So yes, I do think there's a good chance they're going to pause in September, and then we'll see what happens after that. This whole data dependency is nonsense. In 2020, I remember in August of 2020, I wrote a blog article, and I wrote something to the effect of, I see the inflation genie getting out of the bottle. It's going to be hard to put her back in. Fed needs to start talking, jawboning. This is August of 2020. And they were data dependent back then. The data came out in 2020 and certainly really early 21 that, folks, hey, we Houston, we have a problem. And they sat back and said, oh, we need to be more and more accommodative. We've been down this road before. They need to stop before 2%. That we know. And I don't think inflation is going to go down to 2%. I think my worry right now is the way the inflation numbers are calculated. My worry is the numbers dropping off a year ago are going to make it more difficult to get sub 3. So this may be a little bit above my pay grade. I fully admit it up front. But my concern is that inflation may be putting in a bottom, some kind of small trough here, that either we see it go sideways or perhaps even higher at some point in Q3, Q4, and then people start scratching their head. Look, energy prices have firmed. They look better. So that's a component. I just think people have to be open to the idea that 2% is not coming until we get into the next recession. And I've said this so long. Only morons root openly for recession. I mean, that is the dumbest thing I've heard. And I hear it. I don't say it every day. I hear it once a week. Yeah. That's completely imbecilic if you're in our business and you're rooting openly for recession.
I mean, just turn on CNBC. You're going to hear it a lot. I mean, it's but again, I've talked about this. Most of those people don't manage money, so they just talk out of one side and do something else. So,
well, it's also easy, as we know, look at all the people who don't manage money. They are pundits. They make comments, and then a week, a month, a half a year later, they either revise or disavow what they do every day. As you remember when you're in the business. We mark our books. I get a report card every single day. It was a good day. It was not a good day. It was a good week, month, quarter, or not. And that's how those are my consequences. And that's how you're held accountable. I don't come on and say, oh, things are great. I actually bought Meta right before it came out. And then tomorrow I'm like, oh, I sold Meta. That's not how it works in the real world.
Exactly. Yeah. The market wasn't even open half the time these guys are doing their buying and selling.
That's the best part, right?
Yeah. That's not even open. So speaking of CNBC, Jeffrey Gundlach was on afterwards. I don't know if you saw the interview with him. I just caught a little bit of it. But he was talking. He thought the Fed wasn't going to raise this time. Doesn't think they're going to raise next time. He came out and said he believes the PCE, which is the indicator the Fed kind of alludes to a little bit more than the CPI for inflation numbers. He thinks it's going to come down. It's going to come down to 3%, and that the headline will be 2% soon. And he based it off, again, above my pay grade. I don't know the exact numbers, but looking month over month, the next couple of months, he said the PCE are going against really high numbers, so it should actually come down quite a bit. And maybe that does allow the Fed to pause. But more importantly, that 2% number. I asked Jim Bianco a couple of weeks ago because I don't know where the 2% number come from. Where is that? Why is it 2%? And I'll tell you his answer in a second. Do you know why?
No, but somebody asked me the other day, where did this artificial 2% number came from? Here is what I completely guesstimate, surmise, speculate on. You can't get close to 0 or 1 because it's too close to deflation. And anybody who's been around for a long time, it's my 34th year in business, deflation is so much harder to fix than inflation because they call it that black hole. It sucks you in like Japan for 30 years. So my view is, a bunch of the Fed heads sat around and said, look, we need a target, and 2% is far enough away from deflation to give us some room to play. Maybe some really brilliant academic can substantiate it with something more data-driven, but that's what I thought.
Yeah, Jim was very scientific. He said, I think, quote unquote, they pulled it out of their ass, is exactly what he said. So that was his theory. And he made a good point, though, that I said, well, why can't they change it? 3%. And if you look back, the number might be a little off, but the 20 plus years until the great financial crisis, so into 2008, the 25 years prior to that, CPI averaged 2.9%. which right now we're at 2.98 to be exact in CPI. So why can't we be right here? Why can't we change it? And his response, Paul, was, you can't change it when inflation's high because it looks like they're moving a goalpost, right? They can't do it now. He's like, you can maybe do it when it comes down. Also, every other central bank around the world uses 2 as well. So who are we to say that? So it's like an old boys club. You just can't do it now. But I'm fine with 3%. I don't know how you feel, but I'm fine with it.
a lot of people sitting at home will say, why should we have any inflation, right? Because I've heard a lot of people comment, look, inflation was 9, now it's 3, but prices are still going up. That's because the rate of inflation is still 3%. Prices are going up 3% a year versus 9% a year. They're not going down. The rate of inflation is going down. So if you hypothetically had $100, that means that at 3% every single year, that $100 bill is technically worth 3% less because we're devaluing your buying power, if you will, which is a valid argument, but your standard of living has gone up against it. And I know I don't know where you sit on the gold standard, but that's what the gold standard prevented, until the Bretton Woods Accords. And I don't think there's not, I'm not a gold standard guy. I don't think it's not feasible in this modern day economy. There's not enough gold. Our GDP output's too great, but I don't think there's anything wrong. To me, the Fed funds rate, 5 to 5.25, now 5.25, 5.5. The Fed was smart enough. Yes, I gave them credit. The Fed was smart enough at one point to say, we can't peg it to a number anymore. We need a range. Do the same thing with inflation. Pick a range.
Yeah, exactly.
So, at some point, we're going to get back in recession. Prices are going to go down, and people are going to lose jobs, and we're going to lose jobs every month, and people are going to wish we had that 2% inflation or 3% inflation and two times the job openings for every person to fill them.
Yeah, we just had real wage growth year over year positive, which is a good direction. People are actually making a little bit more money, inflation included in there.
It hasn't happened in a long time.
I know. There's a dual mandate, right? The Fed. There's the inflation, and there's the jobs market. All we've talked about since we came on here for the last 15, 16 minutes is inflation. And I feel like the Fed is so fixated on that they're willing to potentially ruin the job market just to get inflation. Why are they so obsessed with that? Or is it because the job market's holding up that they don't give a shit? Why is this?
I think it's obviously both, but right now the latter. The jobs market is, every month I scratch my head, I go, this is really unbelievable that you're not seeing hardly any give up. We're this far into a recovery. We've pulled back stimulus. Now, of course, I learned about when the Inflation Reduction Act money gets into the economy and the infrastructure money, that is quasi-stimulus that came in, not through maybe traditional channels. But the jobs market is beyond belief strong. And I've posed this for the last 6 months. Let's say, I'm sure some academic is writing about it, but let's say perhaps COVID structurally changed the job market to an extent that won't become glaringly apparent till we get through a cycle. And we're not through a cycle yet because we haven't had another recession. I could say I don't know. What I do know is I see the data. I dismiss the nonsense about government manipulation. I take it at the word. But I'm sure both parties, can spin it the way they want. But the data is the data. The jobs market remains strong. If we lose 100,000 jobs in a month, which is, I don't think we're close, you better believe Congress is going to drag Powell by his earlobes before them exactly. and skewer and lambaste him if he's still raising rates at that point.
Oh, 100%. Would that then lead to a recession, you believe, if we start seeing job losses like that?
So think about it this way. We know we have the longest inverted yield curve, and pick your poison. I like using the 90-day T-bill and the 10-year note. It doesn't matter, frankly. I forgot how many yield curves are out there. There's a lot more than I have fingers. But all the yield curves are inverted. We know that it's been long and the yield curve's been deep. And when the yield curve begins to head towards normalcy, towards not steepness, but starting in that direction, that's when you have your economic issue, challenge, perhaps train wreck. We're not there yet, but I don't see how you're going to normalize the yield curve and get through the next 18 months without some kind of mild recession or flatline growth.
Well, because it has to normalize at some point, right? So it's going to come back up. I mean, the inferior, it's got to, right? I mean, you would
I'm
think.
certainly not going to say this time. I've heard people already say this time is different with the yield curve. Just like they said
Sure.
in February of 2020, this time is different, no recession. No, this is not different. Yield curve, I mean, for me, that's the best predictor of recession. It's just not a timing tool. Like valuation in the stock market. All the pundits talk about valuation, the worst timing tool in all of investing. The yield curve is not a timing tool. It just tells you the landscape is here for a recession. You need a little spark or some kind of exogenous event to trigger it.
Yeah. I mean, I was to go back and say that 18 months ago we had a recession. I would say, basically 2020 when rates were going up, and I mean, really, I was always taught, and maybe I didn't go to the best schools, so maybe I was taught the wrong thing. If you had 2 quarters of negative GDP, it's a recession. I didn't know you had to have the jobs and other stuff involved in it, unless they just changed along the way. But that would have been a recession. At least it felt like a recession to me. The whole smell test, right? It smelled like a recession.
It's funny. I'm on the other side. I understand the textbook 2 quarters of GDP, right? And I hate It's like when someone says, well, the Dow went up, but not a healthcare accounted for 200 points to the Dow. I don't like qualifying numbers, but a year ago when we had back-to-back negative quarters, there was an inventory anomaly in there that got corrected right away. That's number one. And the National Association of Bureau of Statistics, what is it? Bureau. Oh my God, brain fart. NBER. Holy jeez. So they're the final arbiter of recession. The politicians and the economists can say, well, it's 2 quarters or not, but we have a body that is the official arbiter, and they did not declare a recession, and they're nonpartisan. I don't think they're trying to support Biden or Trump or anybody else, and it didn't because how can you have recession when your jobs market was making at that point, I think, 300,000 plus jobs a month? Maybe we have rolling periods of weakness.
All right, Paul. So we've been talking over 20 minutes now about the Fed. I had a guest on the camera who it was a couple of weeks ago, and they said, I don't really care what the Fed does from meeting to meeting. I'm a 10-year investor, and rates are going to go up. They're going to go down. I believe in innovation. I believe in the U.S. stock market goes up 75% of the time. So I'm okay with it. And obviously from month to month and day to day, yes, it's going to swing the markets 100%. You can't ignore that fact. But we saw stocks today basically muted after that. We've had a lot of tech earnings this week. So what is your view? Does the Fed really matter long term? I know you have a portfolio with your short term. And by the way, folks, Paul, believe it or not, about 2 weeks ago, moved some money into the Dow, stocks that track the Dow. And just so happens the Dow closed up for the 13th consecutive time today. I know the 12th was like only the 5th time that's happened since the last century. So 13 is probably even less. So congratulations. That's not the only reason to have you on here. I think you're a pretty nice guy too, but man, that's a hell of a
and good looking.
Yeah, and good luck. I already commented on your hair before we started the show today. So what's your view in the Fed? Do you make your long-term decisions based off this stuff, or are you thinking otherwise?
No, I'm definitely thinking otherwise. Look, okay. Matt, look at how many people fought this new bull market because the Fed was raising rates. This old adage about don't fight the Fed is probably the most dangerous adage in the history of investing. The market's bottomed in October. You're 9 months in a new bull market. The Fed's still raising rates. So if you're fighting the market and you're short, either you don't have a portfolio left or you're out of business. I think Fed background information is important, but let's remember, 01 and 07, when the last 2 big rate cut cycles began, stocks went down more than 40% after the Fed began to cut rates. So for those people who are so simple, they just follow the Fed, you can't have a portfolio left. And the pundits and the money managers, the same thing. You've got to use the Fed's important. But I heard a lot of people coming into the year who told me there's no way stocks can go up because the Fed is selling assets off its balance sheet. And when they sell, stocks go down. Not on my screen.
How about this? You and I still hear this argument every single day by probably over 50% of the people that we associate with, and that might be just watching on TV, reading articles, other colleagues and people we know in the business. I'd say over 50% still believe this is a bear market rally and this isn't real. The S&P is less than 5% from an all-time high. What am I missing?
No, it's what are they missing? We were on.
True, yeah.
We were on here in early January because when you said we were BSing on Twitter and I gave you my forecast, you're like, I got to have you on because I said my base case was a 15-20% gain in the S&P with the scenario for a 30% gain. And you're like, what? I said, yeah. I talked about this from the middle of last year right into January, that everything is lining up perfectly for 2023 to be, I called it in my forecast, it's the year of the bull. I don't know what people are saying and thinking. Bear market rallies do not behave like this. The bull market could end, I don't think tomorrow, but it could end next month, next quarter, next year. Okay, no problem. There's nothing in the market's behavior that says this is a bear market. Nothing. You had the semis rip. Look what transports are doing now. So people are saying, well, we're going to head into, first it was we're heading into recession. That's why the bear market's continuing. Then the pundit said, oh, geez, the economy is kind of gaining itself. Now let's say the economy is too hot and we're heading into recession because the Fed's going to raise more. Can't have it both ways. This is a bull market, period, full stop, end of discussion. I don't want to hear it.
Thank you so much. You just make me feel better because I say it all the time, and it's crazy how people just, you said you can't fight the Fed. That's a big adage on Wall Street. I always believed in you can't fight the tape, which means you can't fight the action of what stocks are doing. The movement in stocks takes into psychology, all the numbers we look at, all the people out there buying and selling. At the end of the day, that tape is the truth. That's all that matters. I can argue that the market should be at 3,200 on the S&P, which Mike Wilson has been doing for a long time. And finally this week came out and said he was wrong, right? He sent his letter to people and said, what do you got in front of you?
My trading notebook, which I have these back to 1990, wow, has a lot of pundit comments and calls from when I first realized that the masses were wrong. So there's an awful lot of people who are eating crow and have egg on their face. So you get someone like Mike Wilson from Morgan Stanley. I don't know him. I've met him once. I'm guessing he is under a lot of pressure from above. But there's an awful lot of guys who still were calling for S&P 1500 from COVID. Then they allowed for the bear market rally to 2,500 from COVID. And now they're like, well, I guess it could go a little, I guess it could go a little higher. If I had to pick, sentiment's amazing at extremes. That we know. You can't argue that. Sentiment is great. In the middle of a move and coming out of a bear market low, you're going to get overbought. You're going to get bullish extremes early in a new bull market. That's just how it works. And then you see mild and modest pullbacks along the way. It's not until you get cracks in the pavement as the bull market ages where sentiment gets to an extreme. You've got more ingredients there waiting for that event to come. Like last year, we'll say it was the Fed. 2020, we'll say it was COVID. 2018, that 20% decline in Q4, we'll call that Jay Powell deciding to flex his muscles. You can go on and on and on backwards.
So speaking of you share a lot of the stuff you do on Twitter. I will say that. So if you're not following, please follow Paul because he does share a lot of the buys and sells you do throughout the days. Is there any area longer term, looking at like a year plus, any areas that you find attractive now or anything that you're avoiding at this time?
So yes, and there's a lot of different ways to make money. To your guest mate, like a Ron Barron who has a 10-year time horizon. That's not me. Our strategies are more shorter term in nature. I'm looking to be a little more nimble on balance. But I would say, I came in the year I loved tech, I loved semis, and I loved biotech. Tech's rewarded us handsomely. I thank God every day for that. Semis have been great, and I've since pared back my position. I've cut 2/3 of it back. Biotech remains a big position. We have not been rewarded. It's been frustrating. I do like biotech. I do think biotech gets a bid. And a lot of the other sectors, they've had these phenomenal runs. Matt, you know that. They've had, these once a couple times a decade runs. So for me, in the here and now, I'm trying to reduce risk in portfolios, cut back beta, the risk versus the S&P over the summer months. So we own, what did we buy? I added to my real estate position today. We cut back banks. So I'm trying to be thoughtful about it. I think I mentioned we bought small cap value. We bought SPLV, which is low volatility, at the expense of the Qs and some bigger tech along the way. I think you've got to be thoughtful. If I'm wrong, and tech just regenerates and takes off from here, I will not complain at all. I'll be happy with what I've got because I've got some, but I just think you've got to be thoughtful after such a great run and broaden out your exposure.
No, I agree with you. I'm more of the Ron Barron for majority of stuff I do, just a long term, because I'm doing innovation plays, not necessarily riskier, but just something that takes a while to play out. So I have to give it time, and I try to get in early. But yes, I'm also a realist that in the near term, the Dow's up 13 straight days. Some of these names have run so much, it's crazy that they have to come back. It doesn't mean that the market's done. It just means naturally it pulls back. And I always call them healthy pullbacks. It's okay to pull back along the way. But you mentioned healthcare, biotech. No, exactly. Yeah, it's a pendulum. It gets too far to one side, it's got to come back. You mentioned biotech, and I'm in agreement with you. I wrote in my outlook for this year, I thought biotech would outperform. I've been wrong on that. And I'm just looking right now, year to date, heading into today, Paul, the IBB and the XBI was tracked, two different biotech ETFs, both basically one's down 1%, one's unchanged. The XLV tracks the big healthcare stocks, unchanged. And the S&P heading into today up 19%. I look at that as an opportunity. So if I'm rolling some money out of, let's say, semis or some of these areas that have moved so much, put it maybe down there, because it's been consolidating for about a year and a half now in a pretty tight range. I think that's the next sector that could really move, especially when interest rates start coming down at some point next year.
I thought, frankly, that when biotech had its last rally, that was it. It's going. And like so many rallies before it stopped prematurely, rolled over, and kind of now we're in the middle of no man's land. But, to your point, I love Ron Barron. I think he is one of the all-time greats. He's got the highest conviction. He sticks to his guns, doesn't care what anybody says, never looks at a view under 10 years. But, huge but, the perfect time for investors to buy a Barron fund is in the middle of a correction, bear market, something really bad, because his stuff just runs up the side of the page. Last year they were ringing the bell to buy a Barron fund, and I'm sure he saw net outflows when people should be buying it. So I agree with you. And you're the same way. You look those really smaller cap gems that you're looking to give a runway of 3, 5, 8 years. Time to buy them is when nobody wants them.
Yeah, it's just hard to do, and it's hard to convince people to do that. We had a stock, not to brag, it's going to be airing on Thursday, but today, Vicor Corp, VICR, has some ties to NVIDIA and some AI stuff. At blockbuster numbers last night, up 57% today. In one day. It's been up. It went from 40 in a low in March to 93 now, but it's been lagging for about a year. It hasn't been doing anything, drifting lower. But you kind of sometimes you have to wait for that, and a move like that in a stock, it's a several billion-dollar company, and a move like that, that's not a one-day move. That's something that followed through all day. It's not based on some speculation. It's based on the fact their numbers are getting better, their margins are getting better, and their business model is finally coming to fruition. But you had to wait time to do that. I didn't know when that was going to happen. That's a tough part about investing like that.
It is. We had that with Accuray. I bought it. I bought more. I waited, and the stock finally went. Which for every one of those, I got a whole bunch more like Tilray, where we've owned Tilray for a while, and that's been nothing but a train wreck and the bane of my existence. But you're right. When it's a non-Dow S&P 500 stock that doesn't get institutional attention, if you really believe in your thesis, then you've got to sit back and relax and not get sucked into, wow, and NVIDIA's down $3. I should go buy more. Stick to your convictions. reinforce your thesis, give it patience, because a lot of times you're going to get rewarded in ginormous ways before the institutions come to play.
Exactly. So we're running a little late on time here, and I know we could talk forever, and one day we will on the golf course. I'm actually going to Pennsylvania this weekend to play with my father in some little tournament. I've been playing a lot in Nicaragua. You'll be impressed. My game's getting much better. So we got to get out there soon. Yeah, we're going to get out. I know you're going to still whoop me, but I will keep it respectable, let's say, when we get out in the course now. Before I let you go, I asked you this last time. I asked all the guests the old island question. What's the one stock, the investment, the sector, the ETF, asset class that you want buying today? I know this isn't your wheelhouse, but if you were to buy one for the next 10 years, put you on an island, your folks, your family, your friends, what's that one you feel really comfortable with, Paul?
And you know what? I came prepared today. I knew you were.
Oh, boy.
Ready? I feel like one of those dumb investment shows, last call. Last pick.
Yep.
Atlassian, Team. TEAM software company. We have a full position in it. I plan on holding it. I don't want to say I'm buying to die with it, but that is my number one pick over the next, 3, 5, and 10 years. I think it's going to be an industry absolute gargantuan giant. They're doing software for the masses, subscription based, that's affordable. They're going to put a lot of the biggies out of business.
I tell you what, I'm going real quickly. I follow the company, but I don't know it nearly, 1/10 of what you know it. But I'm looking at the bottom line growth. It's got some really damn good bottom line growth here. This was a darling back, 6, 7 years ago. It ran up from low double digits to almost $500, $480 a share, back down to 120. And last year, now it's at 176. Was that pullback that company had just based on everything else, that pendulum being too overvalued, coming back to reality on that pullback?
Yeah, it was almost like a dot-com stock. I'll say this. There is a chance that they guide margins lower over the coming quarter or two, which to me is right before the ramp up. So if you do get that pullback where the pundits come out and say, oh, they're margin compression, they're in trouble, I'm going to say it's one of those real short-term kitchen sink quarters or two, buy weakness, and I think people will be really happy 3, 5, and 8 years out. That's that should be a Ron Barron, Matt McCall stock.
I got to tell you that I'm so impressed. I shouldn't put it past you doing your homework. You're probably like in the fifth hole after you hold out, going through your phone, trying to come up with an idea today, huh? I know you out there, but that's awesome. Thank you so much. I wish every guest would bring the energy, the insight, and the fun, and everything that you bring to the show. We love having you on, Paul. We have to have you on more often. Yeah, you have to have you more often. And next time I'm going to go to Nicaragua for a little bit. When I'm back in the States this fall, let's definitely cross paths here somewhere and play some golf, grab a drink.
And either you're putting a collared shirt on next time, or I'm coming in. I don't even know what you call that thing.
It's just a T-shirt. So it's actually $60 T-shirt. It's fine cotton here, Paul. All right. Well, we'll see, and I'll wear a collared shirt for you next time to make you feel good. But honestly, I'm showing off my tan. That's why it's a white shirt. So I don't want to show off my tan. But collared shirt just for you next time. Maybe even a tie. All right. Thanks a lot, Paul. We'll talk to you soon.
I'll see you guys soon. Thank you. Bye-bye.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.